The US dollar. It's the bedrock of global finance, the world's reserve currency. For decades, it's been the ultimate safe haven, a symbol of stability in turbulent times. But lately, something feels different. The dollar has been on a roller coaster ride. We've seen periods of incredible strength, making everything else cheaper for Americans, then sudden jolts of weakness, sparking fears of inflation and economic instability. This isn't just about exchange rates. It impacts your wallet, your investments, and the global economy. For over 70 years, the US dollar has held a position unlike any other currency. It facilitates the vast majority of international trade, especially in critical commodities like oil. Central banks worldwide hold trillions in dollar reserves, viewing it as the most liquid and trusted asset. This dominance isn't accidental. It's built on the size and stability of the American economy, the depth of its financial markets, and a long-standing trust in its institutions. This unique status grants the U.S. significant economic and geopolitical leverage, often termed the exorbitant privilege. However, this privilege also comes with a complex set of vulnerabilities. Any significant shift in global sentiment or economic fundamentals can trigger ripple effects. Understanding these foundations helps us grasp the current uncertainties. One of the most pressing questions around the dollar today revolves around inflation. After decades of relatively low and stable prices, we've witnessed a dramatic surge, particularly over the last few years. This rise in the cost of living directly erodes the dollar's purchasing power. When a dollar buys less, it essentially means its value has depreciated internally. This impacts everything from groceries to gasoline. Consumers feel the pinch immediately, and investors see their returns diminished in real terms. The reasons for this inflation are multifaceted. Supply chain disruptions, unprecedented fiscal stimulus, and shifts in consumer demand all played significant roles. This period has undeniably put the dollar's stability under intense scrutiny, raising questions about its future resilience. Enter the Federal Reserve, America's central bank. Tasked with maintaining price stability and maximizing employment, their primary tool to combat inflation is adjusting interest rates. Raising interest rates makes borrowing more expensive, which slows down economic activity and theoretically curbs demand, thus cooling inflation. However, this strategy carries significant risks. Higher rates can also dampen economic growth, increase unemployment, and potentially tip the economy into a recession. The Fed's actions have a direct impact on the dollar's international value. Higher U.S. interest rates tend to attract foreign capital seeking better returns, strengthening the dollar. But the long-term implications of this tightrope walk are still unfolding, adding another layer of complexity to the dollar's narrative. Beyond domestic economic policies, the dollar faces increasing challenges from the international arena. Talk of de-dollarization has grown louder, particularly among countries seeking to reduce their reliance on the U.S. currency for trade and reserves. This isn't a new concept, but recent geopolitical tensions have accelerated the conversation. Nations are exploring alternative payment systems and increasing trade in local currencies. The rise of economic blocs like BRICS and increased trade ties between countries like China and Russia are examples of these efforts. While these initiatives are still in early stages, they represent a gradual, persistent pressure on the dollar's global dominance. If the dollar's role as the primary reserve currency were to diminish significantly, it could have profound implications. It would reduce America's influence, make borrowing more expensive for the U.S. government, and potentially weaken its financial markets. This is a slow-moving but potentially transformative trend. The advent of digital currencies, both private cryptocurrencies and central bank digital currencies, adds another intriguing dimension to the dollar's future. Cryptocurrencies like Bitcoin offer an alternative, decentralized financial system, albeit one still prone to extreme volatility. While not a direct threat to the dollar's reserve status today, they challenge traditional notions of money. More significantly, central bank digital currencies, or CBDCs, are being actively developed by many nations, including China, with its digital yuan. If widely adopted, CBDCs could streamline international payments and potentially bypass the existing dollar-dominated SWIFT system. The U.S., too, is exploring a digital dollar, but its development is proceeding cautiously. The rise of digital alternatives could reshape the global financial architecture. It introduces new competition and could either reinforce or erode the dollar's current position, depending on how effectively central banks adapt to this technological shift. This innovation creates both opportunities and significant risks. So what does all of this mean for you, the average person or the savvy investor? A strong dollar makes imported goods cheaper, which can be a boon for consumers. It also makes international travel more affordable. However, a strong dollar makes U.S. exports more expensive, potentially harming American businesses that rely on overseas sales. Conversely, a weakening dollar means higher import costs, contributing to inflation within the country. It also makes foreign assets, like international stocks or property, relatively more expensive for U.S. investors. This constant fluctuation directly impacts your purchasing power and investment strategies. Understanding these dynamics is crucial for making informed financial decisions. Your retirement savings, your mortgage rates, and even the price of your morning coffee are all indirectly linked to the dollar's global performance. The interconnectedness of modern finance means these issues aren't abstract. They're deeply personal. For investors, the dollar's trajectory presents a complex dilemma. Do you hedge against potential dollar weakness by investing in foreign currencies or gold? Or do you lean into its traditional safe haven status during times of global uncertainty? The answer is rarely straightforward and often depends on individual risk tolerance and investment horizons. When the dollar strengthens, assets denominated in other currencies may appear less attractive to U.S.-based investors. Conversely, a weakening dollar can make international investments more appealing, offering diversification benefits. Diversification across different asset classes and geographies remains a critical strategy in an unpredictable environment. Staying informed about macroeconomic trends, central bank policies, and geopolitical developments is paramount. Active management and periodic portfolio reviews become even more important when a foundational element like the dollar is experiencing significant shifts. This requires constant vigilance and strategic foresight. The dollar's future is inextricably linked to global geopolitics. Sanctions, trade wars, and military conflicts all play a role in how nations perceive and use the U.S. currency. When the U.S. uses the dollar as a tool of foreign policy, it can prompt other countries to seek alternatives, especially those at odds with American interests. For instance, the freezing of Russian central bank assets denominated in dollars after the invasion of Ukraine sent a powerful signal globally. While demonstrating the dollar's immense power, it also sparked concern among some nations about the weaponization of finance. This further fuels the de-dollarization narrative. The ongoing competition between major global powers adds another layer of complexity. As different economic blocs emerge, their reliance on the dollar may naturally decrease. These geopolitical currents are slow-moving, but exert powerful, long-term forces on the dollar's international standing. So what happens next? There are several plausible scenarios for the dollar. One is a continued gradual erosion of its dominance, with other currencies slowly gaining ground in trade and reserves. This would be a soft landing, a slow shift over decades rather than a sudden collapse. Another scenario involves a more significant challenge, perhaps driven by a sustained period of high U.S. inflation, a major geopolitical event, or a rapid adoption of alternative payment systems. This could lead to a more abrupt decline in its relative importance, though a complete loss of its reserve status is still considered a remote possibility by most economists. Conversely, the dollar could maintain its strong position, especially if the U.S. economy remains robust and its financial markets continue to offer unparalleled liquidity and safety. In times of crisis, the dollar has historically proven to be the ultimate safe haven, and that resilience shouldn't be underestimated. The future is a complex interplay of these forces. The key takeaway is that the dollar's position, while still preeminent, is not immutable. It is subject to continuous pressure from economic forces, technological innovation, and geopolitical shifts. Understanding these forces allows us to better navigate the uncertainties. For individuals, this means staying aware of inflation's impact on purchasing power and adapting personal financial strategies. For investors, it means considering global diversification and understanding the risks and opportunities presented by currency fluctuations. The world of finance is always evolving. The dollar may not be dying, but it is certainly transforming. Its role in a multipolar world will likely be different from its unchallenged dominance of the past. The question isn't whether change is coming, but how quickly and in what form. What happens to the dollar impacts everyone. Keeping an eye on these developments isn't just for economists. It's essential for anyone who wants to protect and grow their wealth. The financial landscape is shifting, and staying informed is your best defense. We've explored the intricate web of factors influencing the dollar, from inflation and central bank actions to global geopolitics and digital currencies. But this is just one piece of the puzzle in the larger economic landscape. What does the shifting role of the dollar mean for the future of global trade and commodity prices? We'll dive deeper into that critical connection in our next video. Make sure you're subscribed so you don't miss that crucial discussion. What are your thoughts on the dollar's future? Let us know in the comments below.